Hello and welcome to another Major Market Movements video blog update for December 11th, 2014. I'm Quad G and we're taking a look at engulfing candles in this video, starting off with the outside key reversals. In this particular example, we're looking at silver on a daily chart, and you can see back here in late June of 2013, we had on a daily closing basis, we had an engulfing candle to the upside, closing above the previous 1-2 opens. So that would be a bullish outside double key reversal, or an OK2R. And you can see here the reason that it's an outside key reversal is because the intraday price movement, the shadow of that day, came down below the previous candle's low. So from that point, it reversed and came up and closed above 1-2 previous negative candle opens. So that's a OK2R. And then from that point, that set a key support and a tradable bottom right here at about $18.19. So the market came up a bit, not much in the way of fall through right off the bat, but it did dip down, give a nice, fairly low risk entry for a long position. And then from there, we'll back up and you can see how this simple candlestick maneuver set a very key significant low in this market, and then from there the price skyrocketed up here into the $20, $24, $25 range. And then it was met with, as you can see here, a inverted hammer candle, which topped that price movement, and then it fell back down again. All right, so let me show you some other examples. Here is a bearish outside key reversal. This is in the gold chart on another daily. And you can see here with this candle, we had another outside move. The intraday high went above the previous candle's intraday high, and then the price action reversed, closing below the previous candle's open right there, that blue line at 1369.91. And once that took shape, that set a significant key resistance, tradable top there at 1391.97, and it was sell-off time from that point forward. You see there was some significant fall through, just over about $100 free fall there over a few days. Another thing that you also want to look for, just like all other types of reversal candles, is that they're well placed, and this shows a really nice well placed OKR after a few days of uptrend. So that's another clue to be watching for. And let's move on to inside key reversals. This one is of wheat, and you can see here, as you zoom in, that this particular day opened up. It didn't produce a shadow, but it did open up and ended up rising fairly quickly to close the day above the 1, 2, 3 previous negative opens, and that set a inside triple key reversal. And it's an inside reversal because the shadow in this particular bullish candlestick pattern did not go below the previous negative candle's low there at 440. So one of the other key differences between an inside key reversal and an outside key reversal is that an inside key reversal doesn't quite have the same momentum as an outside key reversal. So what I typically ignore most inside key reversals, just a single reversal. For example, if this reversed and came up and closed, say right here at 451, that would have been a simple inside key reversal. That by itself may not have been enough to take action on. It would have been better for the market to come up and close at least above two previous negative candles for an inside double. An inside double is about the same potency as a single OKR. That set a key support tradable bottom there at 440, and then this market just shot up very quickly up towards the 800 level. You see it just went crazy to the upside here, well into 800 plus before it topped out. So these candlestick patterns can be very, very exciting, very potent, certainly worthwhile to pay attention to. And let's take a look at a bearish inside key reversal. This is the SPX, the S&P 500. And back here in October of 2007, it's on the weekly chart. The SPX came down and closed this, engulfed the previous 3 weeks with an inside triple key reversal there, and set a significant top right here at 1576.09. And you can see as I back out here from that point, that candlestick pattern set this major top in the stock market, and it proceeded to collapse over the next several months into early 2009, with some assistance from a couple OKRs here as well. Single OKRs set key tops here in these little dead cat bounces before you continue to see some follow through to the downside. So what's happening in the near future? Let's take a look at SPX right now. This is what's taking place right now in this week. I don't think it's been updated for this particular day. This is Thursday. But you can see if tomorrow, Friday, the week closes below, say, 2038, you're going to see a triple inside key reversal setting a significant top there at 2079.46. So if however this reverses and comes up and closes back above these previous bullish candles, then obviously that's not going to pan out. So very important close tomorrow, next Friday, or this Friday coming up, to pay very close attention to that, because that could set a key top, a nice tradable top for any kind of uptick we may get in the following week. Maybe present a shorting opportunity for some follow through to the downside. Now, candlesticks are not perfect indicators. They can and do fail from time to time, and even a failure can produce some follow through in the opposite direction. So they're living in a world of probabilities. Everything is a probability. There's nothing in charting or trading that's a 100% accurate or 100% secure by any means. But these kinds of candlestick patterns can increase the odds in your favor when attempting to trade. If you would like to learn more about how to apply technical analysis to your trading, consider signing up for a free 30-day free trial to majormarketmovements.com, and you'll get my daily reports where I show the charts and trade setups on a daily basis. Reports are sent out usually after the close of every day, prepping you for trades that evening or for the next day to come. I hope you found this video helpful and informative. All the best to you. Adios.